Hey all, welcome back to another episode. So this is the second episode of our fundamental analysis. So the first episode we saw about gross margin, how to find out the profit and all those things. So today we are going to discuss about how a banking or bank has to be evaluated, how to find the financial health of a bank. That is what we are going to check, and this will be very helpful to understand and find the valuation for us specifically for bank. And the another thing is, so we are not getting into finance education or something. This is purely I'm trying to simplify things so that as an investor you will try to understand where to put your money, right? That is the whole crux of this one. So we are our investors. We just focus on simple things. We need to have things very minimal, very simple, so that we can find a company, whether it's a good company or bad company. That is what the thing is. So let's get into the detail. This is Sundar and you are watching Mindful Finance. Okay, so let's deep dive into this one. First of all, you need to understand the basics, the difference between the other and finance sectors. The reason is each one behaves in a different way. Okay, and valuation of company, the earlier one which we discussed, right, the profit, sales and all those things. So here the bank is the way bank, how it works is, so say this is your bank, right? Your bank is here. So what will happen? The bank completely works based on providing loans, right? How it gives loan, right? It need money to give loan, right? How it gets money? It gets money from deposits. The people like you and me who are depositing the money, so who puts the money in the bank. The second is equity, like investors, promoters, right? So who are like investing, they'll put their money, they'll put their money as an investment for the bank to run. So deposit plus equity will be its capital to lend loan, right? And it will give a loan in certain percentage. So that percentage of before that, just to tell that this particular thing, this capital, this is not this bank's capital, right? This is kind of money got from the investors and the depositors. So this is almost like a debt for the company, even though it looks like an asset for the company or the bank, but it is actually a debt. So that you need to be very clearly should understand. So this is whenever see the bank's assets, they call this is an asset, but end of the day this asset will become is act like a debt, right? Because it's borrowing money, and they have to pay some kind of interest to the depositors, and they have to provide value to the equity owners, right, shareholders. So that is how the whole thing works. So that is what I have explained over here. The bank normally gets the deposits, right, and provide loans, and it also has to manage risk. How it manage risk? Through a regulator body. Regulatory body, it has to manage its risk, or the regulatory body gives guidance to manage the risk, right? And through the loan, what are the margin they are getting, that is what it is going to be the earning of the earnings, right? How it happens? So I will explain to you in detail. For example, let's put it like this. So this is the bank, right? So depositors, for example, depositor put the money, say 100 rupees. Okay, 100 rupees is provided by the depositor. Equity is not here, but from the equity side, you will be received. For example, one equity cost is the holder is rupees say 10. So total it is rupees 110. It is provided to equity and the depositors, right? When they get this money, what happens is using that 110 rupees, bank has to give certain percentage of money to hold as a reserves. So they have to put that 110 rupees, right? 110 rupees, they have to share certain percent to keep as a reserves. Reserves, I don't want to get into the details, but just to give a high level, reserves will be like a CRR, so which is cash reserve ratio, okay, which is, and another one more thing is SLR, so where bank will invest in a bonds, okay. So this 25 rupees will be split into two part. One is CRR, which is cash reserve ratio, and second one is a bonds, okay. This two area they will put. So basically from the 110 rupees, 25 rupees will go here, right? The remaining would be 85 rupees. So the 85 rupees only bank will be giving as a loan to businesses or whatever it is. When they give this loan, assume that they are giving the loan for 8%. Okay. So here 100 rupees, which is the depositors, right? The depositors paying 100 rupees, right? They're holding money. For that, assume that is 5% is the interest for them. Okay. They'll give 5% interest, and for the loan they are giving 8% as a yield. Okay. Now if you see, if 85% of the loan means, they will get 6.8 rupees as an income. This is an annual one. Similarly, depositor will get rupees 5. Okay. So the net income, which is the bank receipt, what will happen? 6.8 minus 5, because they have to give the money back to depositor, right? So rupees 1.8 is the profit for the bank, which comes around how much? 18%. Okay, the bank gets 18% return from this kind of a transaction. Okay, so again, I'm going to repeat this, so watch it carefully. I got 110 rupees. Bank gets 110 rupees. How they got? From the depositors 100 rupees, from the equity 10 rupees, right? Now from the 110 rupees, they will give 25 rupees to the reserves, and remaining 85 rupees they will give for a loan at the interest rate of 8%. Okay. For this, now what happens? 85 plus 8% is 6.8, right? So which is 91.8 rupees. Now if you add the reserve plus this one, how much? 25, 116.8. So this is the total amount they have. Now in this 116.8 rupees, they have to pay 5% for the depositors. So which is 105 rupees. So if you subtract this from this one, how much it is? 11.8. So what the balance is? 11.8. Now comes the interesting part. Okay, bank, how it works is, the first preference it goes to depositors who paid 100 rupees. Second goes to equity. So equity, how much we paid? 10 rupees. We have 10 rupees. We have, as an investor, we gave 10 rupees. Now this 11.8, I need to give this 10 rupees to the equity, right? So if I subtract this 10 rupees, how much it is? 1.8. So this 1.8 rupees is the earning, which comes around 18%. Hope you got it now, right? How from the bank side, you can see they didn't do anything. You just got the money from here and given to someone. So it's a very very minimal return they get, but it looks like 18% as this based on this one. Here for the reserves, right, which I say 25 rupees. Here also they will get some kind of a return, like the bonds and other things, right? They will get some kind of return. So that will be added as a interest or something, interest revenue or something they will add. So it may go, this is theoretically I am selling 25 without any interest, but in the reality there will be some kind of interest into this one. So that will give some more money. Okay, but for now let's have a simple way. Don't need to complicate. So basically what happens? So now the previously we checked the details about the depositors. Now for the equity, so total annual profit is 1.8 rupees by the bank. The return on equity is 18%. So 18% is the return on investment. Return on equity, right? For the equities, let's slightly add some complexity this one. Okay, what happens in case of a bad loans? What is bad loans? If you're given a loan and people didn't pay that loan for you, or if you are not getting the proper interest from the borrowers, so those kind of a loan will get into the bad loan thing, and that will be called as NPA, non-performing assets. The earlier scenario what we discussed is a very healthy, very positive side. Okay, in case from the 85 rupees loan I gave, the bank paid, right? In that, assume 5 rupees is a bad loan. Okay, so then what happens? Then your good loan is 80 rupees. For that, 8% will become 6.4 rupees. So this percentage of the bad loan, what happens? No, this will create a huge impact on your ROE, which is from 18%, it will fall to 14%, which is almost 36% drop. Got it? I'll explain you. So when In the normal scenario, when there is no NPA, I'm getting 11.8, right? In the other scenario, I'm losing my equity value will become 6.4 percentage. How much I'm getting? 6.4 rupees I'm getting. So from the equity, if I 10 rupee my equity, right, minus 6.4, how much it is? Which is 4.2. My equity value is reduced to 6.4 now. You got it? Equity price has gone down. Why it has gone down? Because I'll tell you. Okay. The 80 rupees scenario, which is 6.4, is 86.4, right? 86.4 plus reserves 25. How much? 111.4, right? Now I need to pay 105 rupees to the depositors. That depositors will always get 105 rupees because it's a fixed, guaranteed return, right? They cannot reduce that interest rate. So it's always 105. So if I subtracted that one, how much? 4.4 rupees. Now if I subtract this 4.4 by 10 rupees, which is my equity, right? Equity, which is 10 rupees. If I subtract this one, 6.4. So my equity value gone down to 6.4 rupees now. Earlier it was 10 rupees. Now it is 6.4 rupees. Hope you are able to follow. If you are not able to follow, please post in a comment. I'll try to explain in the comments also. Okay. But in a nutshell, if you see, if you face this kind of a bad loan, your EPS earnings will go, return on equity will go down. Okay. Here from 18 percentage, it has become 14 percentage in your ROE, which is a 36% down, 36% decline. So basically the point here is, if the bank is giving a loan, the major thing is handling this kind of a bad loan. If it has more bad loan, this earnings will go down, and also in the future, right, it affects a lot. More than that, what will happen now? If you see how the bank is giving the loan, your equity is earlier 10 rupees, now it is 6.4 rupees, right? So depositors having 100 rupees, equity is 6.4, which is 106.4. In that, if I give 25 rupees to the bank, so for the reserve government, how much? 81.4. Now earlier I had 85 rupees to give loan. Now I'm having only 81.4 only I can give us a loan. But just imagine, if I already given a loss of 5 rupees, right? My lending capacity also is going down, right? And my growth also is going down because I cannot give loan anymore now. I don't have capital. Without capital, how would I give loan? So this is going to be a very, 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 very big problem unless and until this 5 rupees is going to slowly reduce to 3 rupees, 2 rupees, 1 rupee or 0. If this is not happening, if it keeps increasing, instead of 5 rupees, it becomes 6 rupees. Gone. That's it. Right? That is why all the small banks, like micro lending banks, they are facing a lot of problem because their NPA is a big issue. Government is coming and trying to help that part, but how long they can give, right? So, and in case this NPA is not received, okay, this 5 is not received, what will happen? That is where the reserve, which is 25 rupees we have, right? 25 rupees, the reserves. One is cash reserve ratio, CRR. One is through bonds. So they won't touch the bonds. First, they'll try to use the cash in the deposits. Next, they'll use this one, cash reserve. They'll have some kind of a percentage for the cash reserve. But government RBI will have a guidance that a bank needs to have certain amount of money always, because somebody comes and asks, withdraw the money, they need to have money to give it immediately. So that is where this CRR comes into the picture. In case this 5 is not given or some 5 is not returned back, so they have to withdraw this 20 from the 25. They have to withdraw, and their reserve will become 20, and they will back to be 85. So that still they can start giving loan here. But again, 85, my reserve is still reserve has become 20. My return is safe. Earlier, how much was the return? 6.8, right? If I get the 6.8 also return, how much? So 111.8. So in this, I need to give 105 rupees. How much it is now? 106. In this, I need to give 6 rupees. So it becomes 6.8 now. From 6.4, it becomes 6.8. But still, my return is less only. Got it? So again, I need to increase my reserves. How will I? So what are the profit I'm getting? I need to start adding to my reserves. So this happens in a cyclic way. That is how bank works. So you need to understand the business in a way that bank is very thin margin business, which is very NPA sensitive, and reserve is very important, and depositor is high priority. This is high priority. You need to make sure depositors are keeping money, which is called CASA ratio, current account saving account. CASA ratio is important. That's how you get money in a bank and you can lend loan. And the third, another important thing is, so these are the ratios you will be looking into the for the bank. But I don't want to get into the thing. Already we discussed ROE, net interest margin. So to evaluate the bank, you need to check the profitability. You need to check the asset quality, like how much NPA is there, and capital adequacy ratio. Okay. So how the capital adequacy ratio is calculated is, so how will you calculate the capital adequacy ratio is, your equity is 10 rupees, your reserve is 25 rupees, the loan you gave is 85, which is 125 by 85, which will be around 41 percentage. This is your capital adequacy ratio for the normal scenario. What that means, you have this much of amount to repay the loan. Like if anything happens, like 41 percentage you have, that amount you can repay your non-performing assets. In case this the NPA we assume, right? So where our equity becomes 6 rupees, my reserve is 25 and my loan is 80. In that case, 31 by 80, which would ultimately will become 39 percentage, which will be around 39 percentage. So your capital adequacy is reducing. So you have to make sure the bank is maintaining the good amount of capital adequacy ratio, so that your growth means it increases. So basically you need to think about the loan, how much loan you are giving, what is your capital adequacy ratio, what are the asset qualities you have, and the profitability. This is how you will evaluate the bank. Let me show some example for Bandhan Bank. If you look at the Bandhan Bank here, whatever we discussed now, you can apply all those things here. You see here, if you see the quarterly result, the revenue is growing, interest. So they are getting interest of this much, because bank you need to check the interest, right? Like previously we see sales, then operating profit, operating margin, all those things we checked. If you remember, those are for the normal companies. But banking, you will see first how much their revenue, what is the interest they are earning from their loans, and the expenses. So financial profit is now Bandhan Bank is showing minus 40. The reason might be, as I mentioned, they would have used the profit to close their non-performing assets. Okay. Why I'm telling is, if you see the non-performing asset net NPA, if you see, it was initially around 3.01 during 2021, and it got reduced. Now it is, last it was 121, 1.29. Now it is 1.28. So they're trying to reduce that NPA slowly. This is what affecting the returns. So net profit has reduced. Okay. So this is what you have to look at the banks, how the NPA is there, how the, let's see HDFC Bank. Look at their, see net NPA. There is no NPA at all. See, there's no NPA. So that is why the brand, the big company, big bank, these are the big bank, right? Trustable bank. That is why these are in the large cap fund. Let's see Ujjivan Small Finance, net NPA 0.56, 0.41, it has increased. Ujjivan, it has increased. But if you see the financing profit, here also it is in minus. So all the banks are, small finance banks are, that is why facing problem. Why? They need to have the reserves, right? You see the balance sheet, reserves, look at the reserves. Reserves, this is 5,000, this is 3,000. I told, right? Now reserve has reduced because they are using the reserves to close their NPA. Let's go back to Bandhan Bank again. Look at the reserves. Reserves have increased. So they didn't touch anything on the reserves. They have increased the reserves. But what happened is they are trying to close the NPA through their profit. Okay, that is why if you see, then there is a negative profit, you can see, right? It was negative. It's negative. So your homework is, now you have to do the similar analysis of ICICI Bank or any other bank which you guys feel, and let me know your point of view about how the bank is doing, whether it is good or not. So here, if you see the Bandhan Bank, everything is good and they are trying to solve the problems through So means reducing that NPA, right? And their reserves also very good. If let's see the CASA ratio, right? We need to see. We need to read their annual report. Let's okay. Here is the Bandhan Bank. So let's see the Bandhan Bank's report here. See the CASA. Year on year growth is 5.5 percentage. FY24, their CASA was 42.4. Now it is 44,735. So their deposits also increasing. So these are the things you need to look how the bank is growing, whether these things are growing or not. Every bank you have to check their what are the parameters improve the growth, right? You need to have more deposits, and also the deposit for the deposit they have to give less interest, right? If they increase the deposit interest for the deposit, there also will be a problem. So you need to check how much interest currently they are giving for the savings account or whatever it is. So that will give more revenue. So if you see net NPA, it is reduced 32.9 percentage, right? You can go over in this and check, see total deposits, total loans and advances, net interest margin, CASA ratio, return on assets, return on equity, what is cash to deposit ratio, right? So these are the main ratios. You can see banks will provide all this, their annual report or quarterly report. You can see all this data. This is what will help you to evaluate the banks and loans and advance. What are the types of loans they are giving? If they are giving loan for small businesses more, then there is a risk. That is also you have to check where they are giving more loan. Whether the asset quality, which is like the loan which they are giving to a good company, a good people, a good business, that is also you need to check. Hope you understood how to read the or value the, banking, any kind of a bank. This would have given a very good idea for you to whether to invest in certain bank or not. Give me your feedback, give me your comments. If you have reviewed any bank, put it in the comment so that we can have a conversation on the bank. If you like this video, give a thumbs up, post your comments, and keep motivating me so that I can post similar videos. Thank you.